Good evening, folks. Good morning or good night, wherever you're watching this transmission. It is I, Mike Martins, bringing you a little bit of down under housing talk from down under Australia. Keeping a close eye on what's happening in New Zealand and Australia because they've been hit pretty hard as a country as a whole, especially New Zealand, with the amount of country has very limited land and very limited options when it comes to relocation, right? So we'll look at some articles tonight discussing that, and I've been following the housing market in Australia for the last, I think, 5.5, 6 years, and it's been really tough there. Sydney and Brisbane, up and down, not down a lot, but just unpredictable numbers for the last 5 years. Now with regulations on taxes and regulations on what you could expense on your taxes, and the depletion of capital outflows coming in from China are giving a more clear picture on what's happening in the housing market down under. New Zealand, with them informing people that they're not going to be selling to foreigners anymore or foreign investors, and putting in stipulations to protect the New Zealand proper. The Australian proper pretty much bought out. There's just when they see a slight dip in the market, a few years back, people will be like, oh, is this it? Is this it? Is this the roller coaster coming down? Nope, pops back up another 2-3%. Then when you see a slight dip in the market, oh, this could be it. This could be crap. People waiting on the sidelines for decades trying to get into these housing markets. And the problem with the housing market the problem with a housing market is if the youth or first-time buyers are not buying. The problem is first-time home buyers, in my opinion, they play a very major role in the housing market, and their absence has been a very big drag on the economy in Australia and in New Zealand, Canada, and the UK, right? It would have been a bit different. The market would be a lot different right now if there were a lot more first home buyers coming into the market, and I think a definition of a first time home buyer is someone's commenting here, Mike. There was a Remax ad on your video. Interesting. So AdSense has pretty much cut me off on most of my videos, saying that they're not real estate friendly, I guess, and or not advertiser friendly. So I just found that someone just messaged me to tell me that, and it's so late, and I just wanted to acknowledge that with you guys. Anyways. And the supply available for homes, affordable homes. There's homes available, but affordable homes for first-time buyers has been tight in Australia and New Zealand, and that's been pushing the markets higher. But they're like, oh, keep building more, set up more cranes, build more condos, build more affordable units, build boxes in the sky. Well, it's unaffordable. It's at a level where it's just completely unaffordable and untouchable by the Australian proper. Even a doctor. Hi, what do you do for work? I'm a doctor. Well, you're broke. Good for you. With student loans and all the bills you have to pay, you're broke. Doesn't matter how much you make, it's how much you spend. Anyways, guys, let's get to this article here. I really want to touch on these articles here with you guys. Sydney property prices begin to plummet. Cracks are beginning to show in the Sydney property markets with the inflated prices from 6 months ago dissipating. So, if you remember 6 months ago when I was reading my articles, the craziness of people having to commute 2 hours to work, the craziness of people having lawyers, doctors, plastic surgeons, engineers having to live outside the city, far outside the city, because they can't afford to buy something locally. Like, how's the infrastructure going to survive? Anyways, In some suburbs, prices have fallen as much as 30% as the median house price copped its largest knock since August 2008. Alleluia. Alleluia. In the 3 months of December, the harbor city's median price fell 1.3%, tumbling a further 2.5% in the following 3 months of March, CoreLogic data shows. The steepest drop in a decade, with the average price of a home now priced at $880,000. So just over $880,000. CoreLogic's Kevin Brogan said the tide was slowly turning. Well, what did they think was going to happen? You're giving out free money at zero rates with these what do you call them, capital easing or quantitative easing and giving free money. Of course the prices are going to skyrocket, to balloon to the sky. Now interest rates are looking to go up maybe 5-6 times in Australia, and then what's going to happen? You know what I'm saying? Something needs to give. And then you're like, oh, if interest rates go up a few percent, Mike, that's not too bad. No. On $800,000, do you know what 5% interest is on $800,000? That's like $58,000 a year in finance charges. Like $60,000 a year in finance. That's not like property tax and all that Mickey Mouse. And water and heat and all that other jazz. That's just finance, and that's not paying down your principal. CoreLogic's Kevin Brogan said the tide was surely turning. I don't think there's any case for panic, he said. Calm the investors. You got to calm the investors, because if everyone wants to pull out at the same time, you'll have a runoff on the housing market. At the moment, it's trending towards a buyer's market, but I think we're seeing it quite gradual adjustment to the market. That when rates start going up. Experts say a crackdown on investor loans, increased stock, and the curbing of taxes benefit has contributed. I think the market will certainly been corrected. So what? It's over? It's not going to drop anymore? I think the market has certainly been corrected. That's it? It's not going to drop? We've got vendors now that are genuine about selling and meeting the market. Auctioneer Sebastian Inner West End said he and agent Gavin successfully sold a 3-bedroom home in Eldwood today for $1.522 million. So if rates go up, okay, and if this is an Australian proper that bought this property, not an investor, an Australian proper that works 5 days a week, you're looking at about $118,000 a year in $96,000 a year in finance. Is it? Yeah, about $96,000 a year in finance charges. So I don't know who could have, but anyways. And this is a 3-bedroom home. This is not a plantation, an estate, a manor, a farm. This is just a 3-bedroom home. Okay, my house has 10 bedrooms and a den and 6-7 bathrooms. So, and I paid $260 for my house last year. I'm finding buyers who would be able to borrow $1.5 million can only borrow $1.2 million this year, and it's going to get worse. Mr. Sanan said, over the past fortnight, the auction declared a rate dropped to just 56.1% compared to this time last year when it was 78% of homes were selling. In 2017, we were averaging 4 or 5 bidders at our auctions. Now we're averaging 2 bidders at our auctions. Despite the downturn, Mr. Cooley experienced a quick auction today with a warehouse conversion selling for $2.7 million after only 5 bids. So that's basically where things are headed. It's going towards investors, huge investors. I think the Australian proper is in a lot of trouble. You know, especially if you're living in Sydney. But there's gonna be a huge correction. You think that's it? You think that's not gonna fall any further? Watch out. Cracks showing Sydney property market as prices begin to plummet. The cracks are beginning to show in the Sydney property market, with the inflated prices for 6 months ago dissipating. In some suburbs, prices have fallen 30%, so it goes back to the other article I just read, but different photos. So you notice how they're trying to, this is the exact article I just read. You notice how they're picking up the same stories and putting them through different news media sources in Sydney, and they're making it seem, you know, like calm investors. Hey, I think the market's been corrected. Hey, if I was an investor and I lost 2.5% on my investment off $1 million, and I lost 2.5 points of that, you know what? I would basically say, wow, has it been corrected? And I keep reading the article. The market has now officially been corrected. It says it right here in this article too. Watch. Right here. I think the market has certainly been corrected. I would feel calm if I was an investor and I read that. I'd be like, okay, I could take this 2, 3, 4% loss. I can handle that as I could take that loss. But I think there's a lot more at play right now. Let's head over to Wellington, New Zealand, for those that don't know. Wellington woman flabbergasted by $165 hike in weekly rent. So she's paying $500 now, or $535 a week. So I'll read it's an interesting. I want to read this to you guys. A young couple have had to pack up and move out of their Wellington flat after being told that their weekly rent was being hiked by $165 a week. Haley Young, 21, and her partner, Sku Sidhu, 26, were flabbergasted when the property manager of the 2-bedroom Newton flat they were living in with 2 friends told them that the rent will rise from $535 a week to $700 a week if they renewed the lease. So, you're probably wondering why in New Zealand they're paying their rent weekly. It's because there's 52 weeks in a year. Okay? And because there's 52 weeks in a year, you have some months where you get 5 Fridays, right? Or 5 weeks in a month where they're a bit longer. And it's a bit of a little break, especially if you're paying month to month, you know, your bills and stuff. It's a little bit of a break to have that extra pay. In New Zealand, you pay every week. So you're paying an extra 4 or 5 pays a year. Or 3 or 4 pays a year because you're not missing a week. You don't have the extra couple of weeks in a month, couple of months due. You know what I'm saying? So I wonder what they do in February. Do they add, I guess, I don't know. Anyways. So Young said that the maximum occupancy was also to drop from 4 people to 3. So it's sad. People, like, that's a lot of increase. That is $535. So let's just say 160. Yeah, 165 times 50. That's $700 a year or something like that. I don't know, but that's a lot of money. Housing price lull doesn't fix the problem for first-time home buyers. So remember what I told you guys about first-time home buyers and the importance of them. You know, during these housing booms in New Zealand and in Australia, a lot of people didn't get a chance. You know, leading up from about 2002 and up, a lot of people didn't stand a chance. And then the employment rate in these countries have been going up, and I know a lot of mining in Australia has been going down. there needs to be a shift to more home ownership by the citizens of the country, because there's a phenomenal amount of empty units across each country. Like each country, Australia and New Zealand, there's just a phenomenal amount of empty homes, and the cranes and the constructions don't stop. People are sending me images from all over the place, and I think what's happening is a lot of the builders are beginning to realize there could be a lot of more growth potential if there were first-time home buyers in the market, instead of the higher-end housing. So I don't know, like I'm just kind of playing it by ear. First Q1 is going to be out in a few weeks. Right now is March 17. Today's St. Patrick's Day to everyone. Happy St. Patrick's Day, by the way. So, well, we're going to see what happens. So let's look at this. It's almost April, and this is the first column I have written about the housing market this year. What gives? We still have a housing crisis, right? Why did we stop caring? I'm at risk of coming across like a fair weather Warriors fan, the kind who only gets excited about rugby league when they make the playoffs. Actually, I am that guy. But I am still interested in the property market. I have a self-interest bias. I own a house in Auckland. To be fair, I own the one I live in, and I also have kids who want to buy one someday. So I'm pretty ambient about my house price, my own house price. Me too. I'm really concerned about when my kids one day want to buy a house. But I'm definitely biased towards dramatic news. Without a red-hot market breaking records every month, house prices haven't been grabbing headlines. There has been plenty of politics, and government prepares to make good on election promises and unleash its Kiwi Build program. And the usual riveting local body stuff, zoning, planning, and yawn. Okay, I know it's important, I get it. But prices are the sexy bit in the story, if only because they represent real data as opposed to endless political debate. And prices have been middling. This market isn't booming, but it certainly is not crashing either. The flow of money data from the likes of Quotable Value, QV, and the Real Estate Institute, REINZ, has been ho-hum. There has been an initial slump, a shift from the annual growth at 20% to less than the rate of inflation was significant. But, as we saw in last week's REINZ data, we're at least a year from that now. REINZ national stats for February showed annual price growth was still steady to strong, depending on where you lived. The national median price was up 6.9%. Auckland, though, was flat. Based on the REINZ House Price Index, the median Auckland price went up 1.1% in the past 12 months. See, that's normal. Housing prices going 1 to 2% adjusted to inflation a year. That's fantastic. Hopefully you get a bit of a raise every time, That's technically a fall of 0.6% if you adjust for inflation. Either way, it's essentially no change. So although the news isn't exactly dramatic, it seems worthwhile to acknowledge we're now drifting into our second year of low house price growth in Auckland. It feels like a very different era to one I was writing about in 2015 and 2016. The hype is gone. Around the barbecue and the water cooler, Aucklanders aren't sharing anecdotes from auctions or whispering how much the way they once did. So what does this mean for young Aucklanders looking to get into the housing market? Sadly, the maths would suggest not much. There is anecdotal evidence of first home buyers coming back to the market as investors were squeezed by loan-to-value ratios. The sense of panic as young people's hopes of property ownership soared further into stratosphere every month has eased. But the reality is we'd need several more years of zero growth, at least, before buying a house in Auckland felt easier. Maybe 7-8 years to catch up with wages and stuff. Maybe 10 years to get to that level, right? Economists seem pretty confident that despite the slight pickup of the past few months, the sideways crawl of the market will continue for some time yet. That's based on confidence that the new government policies will restrict demand. There's the extension of the bright line test for capital gains from 2 to 5 years to further debtors investors. There's the foreign buyer ban, which has been delayed but still expected this year. And the Westpac economists note, in the incoming months, we expect the government to elaborate on its plans to phase out negative gearing. But some big variables could break either way. Immigration is the biggest. It is the elephant in the room for the government. New Zealand first campaigned hard, cutting out immigration rates. Labour campaigned softly on it, but was happy to stay on the New Zealand first side of the debate, despite dialing back numerical targets. New Zealand net migration gain has settled about 70,000 per year. It's hard to see the property market falling for those numbers. The big question is, does the government still have the appetite to cut them significantly? Will Kiwi build ride to the rescue? Will Kiwi build ride to the rescue with a massive increase of supply of affordable housing? Well, to start with, it looks like we'll need to get more immigrants in to build them, which is a bit of a catch-22, at least in the short term. And long-term, other economic issues will start to bite interest rates. Rates are expected to rise from next year. Although higher interest rates could dampen property demand and bring prices down, they also make the equations even harder for first-time home buyers. Servicing $600,000 mortgage at 5% is ugly enough. And I told you guys about this at the beginning of the article, right? Adding 2 or 3% on that would be every bit as bad as another big spike in prices. The reality is there is still no quick fixes. As sanity returns to the market and prices stabilize, it only serves to highlight the structural problems we have in housing. And the failure of our last government to adequately recognize them, let alone address them, is laid even more bare. Anyways, guys, I kind of want to throw some of these articles down under for you guys. I didn't get to too many of them down under from trends in the housing market. On Wednesday, I got a lot of people calling into the show. So let me know what you guys think. Comment below what's happening. Things are definitely cooling right across the board. I'm noticing, obviously, prices are going to drop. Either if prices don't drop, wages eventually will catch up in the next 10 years. And that's another 10 years out of the market. A lot of people will be until they reach that plateau or that level of. So pricing has to come down. Interest rates will go up. I see a lot of foreign investors leaving. I see that too. I see a lot of people walking away from investments when they realize they can't get them rented and the rent is too high to cover their net, if that makes any sense. Anyways, let me know what you guys think. Comment below. I'd like to know. Thanks for watching, guys.